need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touch tone phone. Please note that this conference may be recorded. I now hand the conference over to Mr. Rakesh Shinde, Head of Investor Relations at Aavas Financiers Limited. Thank you, and over to you, sir.
Good evening, everyone. I extend a very warm welcome to all participants. Thank you for participating in the earnings call to discuss the performance of our company for Q1 FY25. The results and the presentation are available on the stock exchanges as well as on our company website, and I hope everyone had a chance to look at it. With me today, I have entire management team of Aavas, including Mr. Sachinder Bhinder, MD and CEO, Mr. Ghanshyam Rawat, President and CFO, Mr. Ashutosh Atre, President and CRO, Selvin Uthman, Chief Business Officer, Surendra Tihak, Chief Collection Officer, Ripu Daman, Chief Credit Officer, Gigi Oman, Chief Technology Officer, Anshul Bhargava, Chief People Officer, Rajaram Balasubramaniam, Chief of Strategy and Analytics. We will start this call with an opening remark by our MD, Sachinder Bhinder, CFO Ghanshyam Rawat, and CRO Ashutosh Atre, followed by Q&A session. With this introduction, I hand over the call to Sachinder. Over to you, Sachinder.
Thank you, Rakesh, and good evening, everyone. I welcome you all to our Q1 FY25 earnings call, and thank you for joining the call in the evening. Let me now take you through the key highlights of our performance in Q1 FY25. We are delighted to report a robust growth of 22% YOY in AUM, reaching 178 billion. Along with the strong growth, we have ensured best-in-class asset quality with 1+ DPD at 3.65%, an improvement of 3 bits YOY, and a GNP of 1.01%. Our net profit for Q1 FY25 stands at rupees 1.26 billion, registering a growth of 15% YOY. In terms of business updates, in Q1 FY25, we disbursed rupees 12.11 billion, delivering a growth of 13% YOY. At the end of Q1 FY25, our AUM stood at rupees 178.41 billion, up by 22%, which aligns with our target to grow our AUM by 20 to 25%. The robust 25% year-on-year growth in the sanction serves as a clear indicator of our robust trajectory, which instills confidence to deliver sustainable growth in the disbursals for the entire FY25. We have opened 4 new branches during Q1 FY25 in our existing states to deepen our reach. We have seen a strong uptake in the logins led by diversified omnichannel lead generation funnel, including digital, e-Mitra, RRO, and Mitra, resulting in better disbursement and building a healthy business pipeline. In terms of technology update, I am happy to share that we have completed the milestone of adoption and stabilization of Salesforce with 1.9 lakh plus loan applications processed through Salesforce. Additionally, we have stabilized Oracle Fusion, our ERP application. A new lead management system built in Salesforce has successfully gone live with selected branches in pilot form. Our loan management system on Oracle FlexCube is at an advanced stage of testing and will go live in the coming quarter. Technology is playing a key role in transformation and turnaround time improvement. Our login to sanction turnaround time has improved to 8 days in Q1 FY25. In terms of financial performance for the quarter, our net profit grew by 15% YOY, led by growth both in interest income and non-interest income. Our consistent efforts to optimize costs have resulted in a remarkable improvement in OPEX to asset ratios by 52 bits, which is now at 3.27 in Q1 FY25 from the previous year's quarter at 3.79. Our asset quality continues to be pristine, with 1+ DPD at 3.65% as of June 24, down by 3 bits over Q1 FY24. Our GNPA stood at 1.01 in Q1 FY25 and credit costs remain at 20 bits. In terms of liability, we are one of the best well-diversified liability franchises. We have always been innovative in exploring new avenues of sourcing, and I am happy to share that we have started exploring co-lending. Our incremental borrowing cost increased by 30 bits YOY and 17 bits QOQ to 8.31, indicating the cost of borrowing peaking out in line with the benchmark rates. The FY25 Union Budget marks a transformative leap in addressing India's housing needs by significantly expanding the Pradhan Mantri Aavas Yojana to include 30 million additional houses, the Government of India's commitment to providing housing for all. We are committed to a strong growth, and our focus on innovation, technology, and cost optimization will continue to drive our success. And I'm confident with our dedicated team and strategic initiatives, we will achieve our goals and deliver value to our stakeholders. I will now hand over to our CFO, Ghanshyam Rawat, to discuss the financials in detail.
Thank you, Sachin. Good evening, everyone, and a warm welcome to our earnings call. First, to update on the borrowing. In terms of borrowing, we continue to borrow judiciously and raising around 11.35 billion at 8.31% in Q1 2025. Total outstanding borrowing as of 30th June 2024 stood at 158 billion. Overall borrowing mix as of 30th June 2024 is 47.8% from term loan from the bank, 24% from assignment and securitizations, 19.6% from NHB refinancing, and 8.6% from debt capital market. During the quarter, overall cost of borrowing increased by 1 basis point quarter-over-quarter to 8.08%. Our incremental cost of borrowing for Q1 FY25 was 8.31%. Lender support continued to remain extremely strong. There is access of diversified and cost-effective long-term financing. We maintain a strong relationship with the development financial institutions. To meet long-term business growth, we have progressed on co-lending tie-up with the PSU Bank. As of 30 June 2024, we maintain sufficient liquidity in the form of cash and cash equivalent and unavailed cash credit limit of rupees 17.5 billion and documented unavailed sanction of 12.6 billion. In terms of spread, as of 30 June 2024, the average borrowing cost of 8.08% against the average portfolio yield of 13.08 resulted in a spread of 5%. We have been able to maintain our spread around 5% in line with our guidance despite competitive pricing pressures. Our margin, NIM as a percentage of total asset during Q1 FY25 stood at 7.31%. Our NIM in absolute terms has increased by 10% year on year Q1 FY25. In terms of cost, our OPEX to asset ratios improved 52 basis points to 3.27% in Q1 FY25 versus 3.79% in Q1 of FY24. We are committed to gradually bring down to OPEX ratio around 3%. Credit cost during the quarter stood at 20 basis points in Q1 FY25 versus 16 basis points in Q1 FY24 and Q4 FY24. In terms of other parameters, profit after tax during the quarter increased by 15% year on year to rupees 12.61 billion. ROE stood at 3.01% and ROE 13.14% in Q1 FY25. IGAAP to India's reconciliation has been explained in detail for profit after tax and net worth on slide number 30 and 32 of our presentation. We are very well capitalized with a net worth of 39.03 billion and CAR at 44.48%. Total number of live accounts stood at 223,600, translating into 16% year-on-year. Employee count was 5,904 as of 30 June 2024 versus 5,700 30 June 2023. Now I would like to hand over the line to our CRO, Ashutosh Atre, to discuss the assets quality.
Thank you, Ghanshyam. Good evening, everyone. I am pleased to share the key portfolio risk parameters with you. Asset quality and provisioning. Our asset quality, as mentioned by Sachin, continues to show improvement. The one-day past due metric improved by 3 basis points to 3.65% in Q1 FY 2025 compared to 3.68 in Q1 FY 2024. As of 30th of June 2024, our gross stage 3 stood at 1.01% and net stage 3 at 0.72%. In terms of geography, 1+ DPD and GNPA in our core vintage states remained well below 4% and 1.1% respectively. Whereas other emerging states, 1+ DPD and GNPA remained well below 3.5% and 0.9% respectively. Similarly, in terms of ticket size of more than 15 lakh, 1 plus DPD and GNPA remained well below 3.3% and 0.8%. Whereas in case of ticket sizes less than rupees 15 lakh, 1 plus DPD and GNPA remained below 4% and 1.25% respectively. Our total ECL provisioning, including write-off for COVID-19 impact as well as Resolution Framework 2.0, stood at 907.5 million as of 30th of June 2024. Aavas is strongly positioned to continue delivering industry-leading asset quality. With this, I open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sripal Doshi from Equirus. Please go ahead.
Hi, sir. Good evening, and thank you for giving me the opportunity. So my first question was on business momentum and particularly on disbursements. So the run rate has come off materially from the 4Q levels. And within housing, the degrowth is even higher. While I understand that 1Q tends to be soft, but what is it that led to this lower disbursements during the quarter?
Thanks, Sripal. As you really appreciate and you highlighted, you always have a muted quarter one. But here I would like to highlight on against robust sanction growth of about 25%, we had sanction to disbursement around 78%, which led to the growth being muted on the lower side actually. But as we really pointed out, on a 25% sanction growth, we expect the momentum to come back in the coming quarters.
So, sir, if we have to look at it from a different angle on a yearly basis, what sort of a disbursement that we are targeting, and how do you see it shaping up over the quarters?
As I said that one parameter on which is that the sanction growth is there on that line, and I said that we are at around 77% on this quarter. And in the coming quarters, we'll have the sanction to disbursement ratio really covering up to the normal levels of 85-87%. That's the normal range which will remain. So we are confident of bouncing back on the quarter number. So what instills confidence is one is the login growth and second is the sanction growth. These are the two parameters which really help us give that confidence of there. So unlike a normal one, we have a sanction group which is already available with us actually, and that will translate in the coming quarters.
So are you saying that there was no, material momentum decline in terms of the number of logins during the quarter?
No, as you reflect, as I highlighted, there is a growth in logins and there is a growth in sanction, and both of them we've given the numbers out. So there's no momentum growth if I were to really talk across. There's a decrease in the sanction to disbursement ratio, which has resulted into the disbursement take on the little muted side.
Okay. So the second part was pertaining to the end use of the other mortgage category that we have classified this quarter. So what would be the end use there? And yeah.
So other mortgage, if you really look at it, it is the MSME side of the part, which is the micro MSME, where it is typically the unserved and underserved, which we really focus on as a specialized HFC, which is very unique to Aavas, which really helps in building the capital creation for the working capital customers on the micro MSME side. And we've seen the degrowth on the LAP and the top-up side, and really it's gone into the capital consumption on the MSME side, and that's around I think that's around 22%.
Okay, so the end use is for the micro MSME purpose.
Yeah. So it's for the micro MSME, right, Shipal, if I have to get it.
No, I was talking about the other mortgages. So
these are typically the loan against property and the top-up loans, which are home loans, which you have the top-up loans, which get classified as the loan against property, and the loan against property, which is for the personal consumption. These are all backed by self-occupied residential properties.
Okay. So the last question was on pricing. So we had done rate hike couple of quarters back. So I think. So why has there not been any improvement on the yield side during the quarter? So that was the question, sir.
Yeah. So I think if you see the disbursement yield, there is an improvement on the disbursement yield on quarter and compared to the previous quarter. But on the overall yield side, I think you've seen not that kind of compression which was normally there in the earlier times. So and maintaining a consistent spread of about 5%.
Okay, got it, sir. I'll come in the queue if I have more questions. Thank you.
Yeah. Thanks, Shipal.
Thank you so much. The next question is from the line of Mr. Renish, ICICI Bank. Please go ahead.
Yeah, hi, sir.
Good evening, Renish.
Yeah, good evening, sir. Sir, congrats on a good set of numbers during extremely challenging environment. Sir, just two questions from my side. One on the spread and the lending side again. So when we look at the incremental cost of borrowing at around 8.3 versus blended cost of 8.07, which essentially means that going ahead, the blended cost will converge towards the incremental cost. And when we look at the yield, it's been downtrending since last many quarters. So how confident we are about sort of maintaining this 5% spread for the full year? I mean, though, we know that we have increased our PLR by 40 basis points, I think in April. But that doesn't reflect in this quarter. Maybe it should reflect in consecutive quarters. But what is your internal assessment?
So I'll have there are two parts of the question. The second part, I'll have Ghanshyamji to respond. On the first part, we've been giving a guidance. Our endeavor is to maintain 5%. And as you will really appreciate that there has been a spike in the incremental cost of borrowing, and the same transmission has not been possible at the ground. So as a result of which, you do not see the incremental increase in the cost of borrowing being able to pass on to the existing set of disbursement customers. And on the yield side, on the placement, I'll have Ghanshyamji to really respond on the second part.
Thank you, sir. This quarter, when we borrow fund, NHB contribution is always remain low than what we borrow for full year basis. So this year, new limit will come once we complete this quarter. Then the contribution of NHB borrowing will increase in overall borrowing. So we are confident that now cost of borrowing is almost peaking out now at this level basically. And we borrowed a good amount of money as a T-bill link, repo link money. So whenever the rate cut come, it will have a positive impact on our overall cost of borrowing basically. And yield side, if you see last quarter to this quarter, we have almost 17-18 basis points higher yield on the new business we got in this quarter. So we are quite hopeful. We are going more granular, more smaller ticket going forward in our business strategy. So I hope that will also help to maintain our overall yield level basically. Or new disbursement will have further increase in yield basically. So our endeavor is that key to maintain this 5% spread going forward.
Got it. And my last question to Satinder sir again, on the disbursement side. So sir, when we say our sanction to disbursement remains at 77 versus 85-87 normally, so which means disbursement is lower by maybe 7 to 10% this quarter because of seasonality. Is that the fair assumption?
One is the seasonality and second is the recognition of the disbursement. As you are aware, I think both of the parts have led to the current, but the positive side in the green shoot is that you have the momentum which is there, which is reflected in the numbers.
Got it. And would you like to share the absolute disbursement expectation for this year?
So we've always guided on our AUM growth of 20 to 25%. I think we are confident of the fact that we will be able to deliver in that range. And I think that will come across by two parts. One is disbursement coming across quarter on quarter, and plus the foreclosures being controlled at the rate at what we have been able to manage. I think both of them really contribute. So we are confident on this side of delivering the growth on the yield, which we've always guided 20 to 25%, with disbursements and contributing, and the BT out being restricted to at a level at which we are comfortable at.
Got it. And then this last bookkeeping question: what is the interest reversal because of the RBI circular?
I think Ramesh, we can discuss offline on this. Whatever is there on the RBI stipulation, we followed completely what is required as per the guideline, what has been mandated. So we will follow the rules and the circular in total.
Okay, so it is fair to assume that by end of June we are fully compliant and going ahead. There should not be any impact. So we are compliant on that, Ramesh. What we are saying is, on the coming quarters, we'll have the bounce back of our disbursement coming into play. Got it. Okay, that's it, sir. Thank you and best of luck, sir.
Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Shweta from Elara. Please go ahead, ma'am.
Thank you, sir, for the opportunity. So sorry, I'm harping on the same question all over again. So we had seen 25 bits PLR increase in Q4, right? But if I look at the yield movement, there might be one-offs in Q1, but when do you see this reflecting ahead on the yield front?
The 25% then explain this question again, please.
So we had seen 25 bits of PLR increase in Q4, right? So why is it not reflecting in the yield movement?
If you see, last quarter we published at 13.13%, and we increased the 25 basis point in the March itself, basically. So in a contractual rate, a 5 basis point drop is on account of fresh business, because fresh business is still lesser than the AUM yield, basically. So there is I don't think there is any contraction in yield reported in our investor deck. Yeah, at a computed level, if you ask me at a computed level, obviously, at a computed level, you see, obviously, due to RBI circular, there is a certain interest cost reversal, and some this March to June end, NP also increased, so that 90 days period also got interest got reversal. If you both the factors there, then there is a only marginal drop, which is equivalent to my AUM will drop.
Okay, fair point, sir. So secondly, how are we placed today on the BT out cases? Has that number seen sort of spike? Because if I go by the calculations on your prepayments and repayments, so could you just throw some light on BT outs for this quarter?
Yeah, if you see in this quarter, overall BT in the industry is a 5.6% at annualized basis, which is within our control, and which is within our last year's track record also, basically. We generally assume in our budget 6% is a BT out to industry. And during the quarter, is a customer close is partly closed account, they pay the EMI also. So overall, my reduction in the AUM is a 16%. So which is within as per the budget, as per our within our assumption, the past year track record also.
Okay, so there is no unusual spike here, right, on the BTR?
No unusual spike here. Last year, if you see overall, this 17.6% was a repayment from opening AUM to closing AUM.
Right.
This year, still we are at a 16% in this quarter.
Mm-hmm. Okay, sir. Thank you and best of luck.
Thank you so much. The next question is from the line of Raghav Garg, Ambit Capital. Please go ahead.
Yeah, hey, hi. Thanks for the opportunity, sir. Just my first question, what is the total number of employees that you had as of June end? And a related question is, why have the employee expenses declined on a YOY basis? Those are my first two questions.
See, on the employee count, as of 30th June, there were 5,904 employees. And compared to the previous year, it is increased about 204. There is a one-time set-off, which is the long-term incentive plan and the ESOP cost, which has got reversed, as a result of which there is an employee cost reduction.
Understood. Sir, my second question is from the annual report for FY24. So what I see is that there is a certain purchase of software worth about 29 crores, which has been capitalized. And when I look at the intangibles under development line item also, there is about 22-23 crores worth of expenses waiting to be capitalized, I think, next year again related to, software. So, can you tell us what is the nature of this expense? And it doesn't seem to be a one-time, capital expenditure because it happened last year, it happened in FY24, and probably you're going to capitalize it again in next year. So if you can, explain what is the nature of this expense, and if this is going to be a recurring expense, then why not, expense it rather than capitalizing it?
No. I think in last few years in the quarterly call and annual call, we explained that Aavas took a complete tech transformations in the company. First, we took a Salesforce as a LOS as a tech transformation. Then we took a ERP, Oracle Fusion, as a tech transformation. As well as during this time, we took a lot of digital initiatives also to have a very, let's say, different level of customer experience onboarding to exit of the customers. And now in this quarter, we are under progress to go live for the Oracle FlexQ is a LMS system basically. All 3-4 systems, and apart from that, there are few peripheral systems are there. Like we took a treasury software also, along with we had upgraded our people software, human software also basically. So all put together is a total capex in the company roughly in 2 years. Something we already capitalized, something will be capitalized. Put together, everything will be 45 crore rupees around capitalization basically, 45 to 50 crore rupees capitalization, all this put together basically. So there is no any revenue expenditure getting capitalized, capitalization is a revenue expenditure, is purely capitalized expenditure. The company will get benefit in the next 10 years, in the entire growth journey it will benefit to us basically.
Understood. So ideally, maybe, in a couple of years or maybe after next year, this capitalization, whatever this amount is, should run down, right? It won't continue at this 25-30 crore kind of run rate beyond next year. Is that the right assumption?
This year is a final year will be capitalization. In this year, by this year, 2 years put together, we will have a capitalization of 45 to 50 crore rupees.
Understood. So the reason why I asked is that, given my limited understanding, I thought it was more of a subscription-based model. But given that, this expense is going to run down after next year, maybe, I'll try to understand it offline from you as to what exactly is the nature of this expense. Sir, my other question is from your annual report, it seems that the MIG and LIG...
Mr. Garg, may we request you to return to the
Sure.
question queue for follow-up questions?
Sure.
Thank you so
Yeah.
much. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone. Thank you for taking my question. So first things first, you spoke about disbursal yields earlier. What were the disbursal yields in 1Q?
Sorry, Abhijit, you said disbursal.
Disbursal yields in 1Q.
So, Abhijit, we've always guided on our the spreads and on our AUM growth. The incremental disbursal deals, which we don't comment because I think that trades off moves across on quarter. I think important is that we've been able to maintain a spread of 5% on a basis of that. On a sequential on a basis of Q1 previous year, I can really say that it is in the range of 15 to 17 bits comparatively of the previous. It is higher by 17 bits actually.
Got it. This is fair. Thank you. So the other question that I had was on spreads. Already a lot of questions have come your way on spreads, but given our guidance of 5% and now that we're eventually here, just trying to understand, given the competitive intensity which is not allowing you to transmit higher cost of borrowings to customers, right? Are we also doing something on the mix side to ensure that even if cost of borrowing stabilizes and the competitive intensity remains this way, which will mean continued pressure on yields, are we doing something about mix as well to ensure that the spreads can at least be maintained at 5% kind of levels?
Yeah, Abhijit, you are right. I think the endeavor, as you rightly said, and I would really articulate in the form that the focus on the ticket size, which is going to be less than 15 lakhs to contribute really higher. And even in the buckets which we are there, incremental increase granularly on the yields, on the disbursement yield is our endeavor. And because of that, we will really try to maintain our spreads. And when we see the peaking out of the cost of borrowings really peak out, we'll try to maintain, and our endeavor is there, and we're working on that. As a result of which, when we say that we've been able to have our disbursement is up, so there is within the focus really is to work across on higher yielding products which are there, which is within the segment which is there, which is self-occupied residential properties, home loan segments, really to build in those lines actually. So that's been our focus, and we will continue to build on that.
Okay. And sir, just one last clarification. Just trying to understand two things or two clarifications. One is, have we changed the way in which we report or compute NIM? Because for the last financial year, FY24, you have reported a NIM of 7.91. For this quarter, you have reported a NIM of 7.31. So is there a change in the way we compute and report NIMs?
No, there is no change in the reporting at a NIM basically. NIM is the same way we compute whatever we reported earlier and now reported. But in this quarter, NIM got impacted by the two reasons. One is assignment income for this quarter is lesser than what we see for the full year basis, because first quarter generally remain limited assignment. But as we progress in the full year basis, it will be catch up on the assignment income. Then full year basis we will have a back to that. Secondly, obviously cost of borrowing got increased. That is also impacted there. Secondly, as we mentioned, our spread got came down. So that is also impacted at a NIM level basically. But one time impact of assignment will come back. Will come back in the full year basis.
Got it. But our presentation is actually showing a 70 basis points decline in the reported NIM.
Yeah, few basis points because spread also came down. So if you take that spread reduction which is there, and then around 20 to 25 basis point is on account of EIS, on account of assignment basically. So that will come back in the remaining year. I think there was question on the spread and all these things. We always say this thing. We will maintain this spread, but you will appreciate this thing. We always give one more commentary. If we lose at a spread, so we will make up the same thing through OPEX leverage basically. So this quarter is last is few quarter. Now OPEX leverage we have around 50 basis point in this quarter.
Got it. Thank you so much, Shamji.
Thank you.
Thanks, Abhijit.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to one per participant. The next question is from the line of Jigar Jani, B&K Securities. Please go ahead, sir.
Yeah, hi. Thanks for taking the question. So on the OpEx front, we were guiding for 20 to 25 bits each year progression. But if I compare on a FY24 basis, we were at 3.58%. This quarter, we are already at 3.27%. So we are well below what we had guided for the full year. So how should we see the OpEx to asset number for the full year FY25? That's the first question. And secondly, the growth guidance that we are making in, which is 22 to 25%, how much upside would be there because of the CLSS announcement in the budget? And if you could also simultaneously share in what format, if you have had any discussions with NHB on this, in what format is the CLSS scheme going to come in? Yeah, thanks.
So we've always guided on the AUM growth of 20 to 25%. On the OpEx to asset ratio, we are at around 3.25 for the current quarter. Our endeavor is to continue to maintain, and some of them, I think, on the employee cost side, which was incidental in nature, which came across in this quarter. I think operationally we will try, and it will be a long-term guidance in the coming year to come to a level of 3%. So we'll continue to strive towards that and maintain that line. And on the CLSS, I think Aavas as a normal strategy has never built the growth based on any of the subsidy schemes or others. We are into specific ones which are going to the self-construction individual homes. Definitely that housing for all PMI work will have a positive impact for us. But nothing on the CLSS specific, we have been guiding on those lines.
Okay, sir. Thank you.
Thank you so much. The next question is from the line of Subhranshu Mishra, Phillip Capital. Please go ahead, sir.
Hi, good evening. Thanks for the opportunity. Just to harp on the CLSS for a second, given that there's been some degree of budget announcement without any fine print. As in how the fine print comes out, do we think that will change our AUM or disbursement growth guidance going forward? That's the first. Second is, what really changes when we see this fine print of CLSS? Because when CLSS got knocked off in 2022, and since then the developers have pivoted towards other kind of inventory. So for them to repivot back into affordable housing will take some time. So in that case, satisfying a disbursement at scale with this scheme would also take time. Right? That's a fair assessment. So
sorry, actually you are not audible.
Am I audible now?
Yeah, now it's better.
Which part did you not hear? The first question or the second one? Should I repeat everything?
So on the first question, what we heard and what we hear right is that we continue to have a guidance of AUM growth of 20 to 25% for the coming quarters.
No, but my question was, with the fine print of CLSS coming out in the next few weeks, will change our AUM and disbursement growth? That is the first question. Second one was, in 2022, the CLSS got knocked off and the developers repivoted towards other kinds of format, which is not affordable housing. So there has been a supply side crunch. This supply side repivoting itself will take some time for the developers to realign to the fine print of CLSS. So do we think that the certification of disbursements at scale will also take time, maybe 12 to 18 months?
I think from that perspective, we are not in the developer segment or in the segment of those builder-led supply which is there. Aavas as a clear-cut focus in Tier 3 to Tier 5 town is more on self-construction individual homes, which is our mainstay. And whatever is then additional, it doesn't have, we are not projecting any growth because of any of the schemes really coming across. the ones which are there on the urban-led supply, which is a part of our affordable vertical in our business, there, depending upon whatever the inventory comes up, that definitely will have an upside for us as a housing finance company.
So, if I have understood that correctly, we won't change our AUM or disbursement growth guidance basis the scheme fine print which comes out in the next few weeks.
What does it mean? What do you mean?
Because today we don't have the fine print of CLSS. Whenever that comes out, will we change our guidance?
Fine print yet to come. But in the last PMI scheme and CLS subsidy, we've seen that it has positive impact on the growth as well as on the quality side. It has improved significant affordability of the home when people take a loan from us basically. So we want to wait for the fine print, but it has a very positive impact.
So the question is that will we change our growth guidance when that fine print?
Let's wait. Let's wait for the fine print, and as what Kanchanji said, it always has a positive impact, A, on the affordability and B, on the quality of which is there. So once we get the fine print, I think we will come back to you on what would be the implications on the growth side.
Sure. Thank you.
Thank you. The next question is from the line of Kunal Shah, Citigroup. Please go ahead.
Yeah. Hi. Sorry if I'm being repetitive because I missed the earlier part. So on the non-home loan side, anything to read into in terms of the GS3? I don't know if that was answered, but there is an uptick both on a year-on-year and quarter-on-quarter. So anything, maybe are we seeing a slightly higher stress even in 1+ DPD or 30+ DPD in that bucket? Yeah.
No, Kunal, there's anything substantial to read across. I think you will really appreciate that as the MSME, which is the real working capital, going across on the non-home loan segment, really going for the capital consumption and really helping us in building the right kind of book. But incrementally, we don't see so much of a difference between the quality or the performance of the portfolio at this period of time. And the other thing you have to really note that this is all secured by self-occupied residential properties which are there. So.
Okay. And secondly, on check disbursals, I'm not sure if that was touched upon, but how much was the impact and has it normalized? And should we see the disbursements coming back to normal? If you look at the July month disbursements, how the trend has been? Yeah.
So, Kunal, the earlier part of the call, we said that we had a sanction growth of 25% on the sanction part. On the sanction to disbursement, we were at around 77%. So we are optimistic of whatever we are there to bounce back in the coming quarters.
Okay, but that will come immediately. So it has got normalized right from the start of this fiscal. This quarter.
It will get normalized.
Okay. Yeah.
Thank you very much, Mr. Shah. The next question is from the line of Anurag Mantri from Oxbow. Please go ahead.
Yeah, just two data keeping questions. If you can, quantify. You mentioned in the employee OPEX there was a one-time reversal. I think if I heard correctly because of the ESOP. So if you can just quantify that number. And the other one on the data keeping again is in the yield, right? I think you mentioned that there is some interest cost reversal because of two reasons. If you can just quantify both these numbers, would be very useful.
Your question for the sequential quarter or you talking year on year?
No, so for this specific quarter, I'm just asking the absolute numbers. So I think in OPEX you mentioned that there was a one-time reversal in the employee cost because of I think some ESOP reversal, if I heard correctly.
Yeah. It's a true sense not a reversal, but it's that key. Because when a certain ESOP is given in the past got matured basically. So now new provision was lesser than the last year's requirement basically. So that was a difference in ESOP basically. And Apart from that, I think is a normal when you compare quarter 4 to quarter 1, obviously disbursement remain higher in the quarter 3, quarter 4. So in those periods, variable costs are generally higher than the quarter 1 variable cost basically as employee level.
Got it. Can you quantify that provision for ESOP number broadly, just to get a sense of how much improvement has happened because of that in the employee office?
So cost in this quarter is 4 crore rupees.
Got it. And the interest cost, the yield of the interest reversal, if you can quantify that as well.
I think that's difficult to comment because those system-based reversal happen in the system itself basically. So we will come back an exact amount.
No worries. Okay. Yeah, thank you so much.
Thank you so much. The next question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi. 2 clarifications from my side. On the cost of borrowing, if I have to look at the bank borrowings, have the incremental rate changed versus last quarter? You mentioned about the incremental to borrowings, but how about bank borrowing?
Bank borrowing, I think from banks we borrow money from the 2-3 benchmarks basically. T-billing money, repo-linked money, and as well as other benchmark 6-month MCLR all put together. So my bank money is borrowed in this quarter is 8.40.
Okay. And what was the same last quarter?
I think the 10 basis point difference is there.
Okay.
Last quarter 10 basis point cheaper.
Yeah. Go ahead. Hello.
Apologies for interruption. Ms. Khetan, we are unable to hear you.
Am I audible?
Yes, you're audible now. Please go ahead.
Yeah. Sure. Secondly, sir, if I can get a share of loans above 25 lakh ticket size and 15 tickets as of today, and what was the number a year ago?
I think ticket size details are too granular number to say at a large forum. We have given us overall ticket size detail in our presentations of how is our loan home equity has grown, home loan has grown. We have seen a natural increase in our ticket size at the home around 6 to 8% in the home loan side, and MSME left put together. You see, we have seen a 10% plus increase in our ticket size at a year-on-year basis, basically.
Okay. If you could just get the above 25 lakh ticket size share in AUM, is that even a rough number you have? That will be very useful. Thank you.
That we can, I think, because we don't have much focus on the larger tickets.
Okay, but do you have a back of the envelope number, share of AUM above 25 lakh ticket size?
Yeah, it's around 5 to 6% on my loan count basis.
On AUM basis.
Yeah, on account. And also my let's say 2 lakh plus customers, there are the 5% customers are there who has more than 25 lakhs.
Okay, on based on the number of customers, not AUM.
Yes, number of customers.
Got it. Okay, thank you.
Thank you so much. The next question is from the line of Aditya Pal, MSA Capital Partners. Please go ahead.
Hello, am I audible?
Yes, you're audible, sir.
Yeah.
Please go ahead.
Thank you. Thank you so much for the opportunity, sir. So just wanted to quickly understand what would be our geographical concentration amongst our top 3 states, and how does the management think about it?
So as you are aware, I think we've already discussed Rajasthan, Gujarat, MP, and Maharashtra, the 4 states which is there. So the AUM accordingly is lined up. And as we will really appreciate of the 371 branches, we have 108 branches in Rajasthan. So based on that, it really is the one which is giving the disbursement as well as AUM remittance. But the other thing to really note is that you had the other states also really coming across. So from a level of 60-70% couple of years back, we are at around 30 to 35% on the AUM level. And since we have 108 branches, we have definitely a contribution coming from the base state. So that's how we are stacked in the 4 states what we talk about.
So these 4 states currently contribute to 35% of the AUM.
No, I'm talking about Rajasthan alone contributes around 35% of the AUM.
Okay, understood. And combined with the top.
I think you should really appreciate that I have 33. We have 33% of the branches pan India which are there in Rajasthan, right? So I have 108 branches of the total 371 branches in Rajasthan.
Understood. And sir, how are we looking at this? Sorry, please go ahead.
Yeah, you were asking about 4 states. The top 4 states contribute 70%.
Sir, also my second question is that how are we thinking on branch productivity? So today we have around 46-47 crores of AUM per branch. Going forward, how are we thinking? And also if you can give a bit color on branch economics. That is, after completing 3 years, what is the OPEX?
I think on the granularity, we don't comment. I think you would really appreciate that the first ones which are there, which actually really help us to build, they help us to really scale up in the new markets, and in the line of our contiguous location expansion strategy, it also to build up the other states and other branches. And our constant endeavor is to really build that in a way which is much more granular, make them cost effective, and make them ROA accretive.
Understood. And sir, any color on how do we think on AUM per branch productivity going forward?
So I think you do not, you look at the market potential, you look at the credit behavior, look at Aavas's behavior. I think all those metrics is a one which really decide what it is there. It is not a secluded division of a numerator denominator. It is more to do with our understanding of the geography in detail, local dynamics, our understanding of the market and the credit behavior. That determines the viability, and accordingly branch our size according to the market opportunity and accordingly resourced.
So just understanding, so when we say 20 to 25% AUM growth, how can we understand how much will come from productivity gains and how much will come from organic?
You see, our AUM happened 20 to 25%. Branch in count will increase by 10% in, let's say, we are targeting 3 years, as well as the manpower will increase by less than 10%. So this will give the productivity leverage every year for 3 years. It's a metric we are seeing.
All right.
Yeah.
Thank you so much.
Thank you so much. The next question is from the line of Nihar Shah from Newmark Capital. Please go ahead.
Hi, good evening to everyone. Just a few questions from my side. My first question is, can you tell us what the BT out this quarter was, and what is the trend been over there? How are you seeing trends in BT out?
So we are saying, good evening, Nihar. On the lines what Ghanshyamji really referred in the earlier, while answering the earlier questions, we continue to be at around 5 to 5.5%. And I think that is backed up by on an annual basis. And this is actually backed up by our good predictive models based on our last couple of years, where we have actually in a position to really predict what would be the customer behavior and actually stop the rightful customers which are there, and wherever we feel that the customer is getting over leveraged or the cash flows are not justifying, we let it flow to the balance for a balance transfer. And we really look at the ones which the customer has been over leveraged, the performance of that in the with outside of us actually is 5 times worse off than it would have been others. So I think a very fact of cash flow based lending, right kind of underwriting, and retaining the right kind of customers has actually helped Aavas over a period of time. And with technology and our predictive models really helping across to predict the behavior and hold the customer despite the competitive pressures and the market, we've been able to maintain that in a range-bound manner.
But is the number of people coming for BT outs also increasing? So, you all are obviously are you all retaining more customers, or is the retention rate also sort of largely similar? I'm just trying to understand that from a competitive and intensity perspective.
No. We, as you know, we are more focused in tier 3, tier 4, tier 5. And we are not seeing any change in last, let's say, couple of quarters, including this quarter, any increase in on the BT out requests.
Okay, fair enough. The second question that I had was, this loan sanction to disbursal ratio. Is there any drivers of that being so low this quarter that was, just, out of the ordinary, or or is there some normal seasonality or something? If you can just dive a little bit deeper into, why you think that corrected so sharply.
You are aware that in this quarter, one regulatory circular was there, and where some disbursement practices got improved in this quarter. So that has impacted us spillover of certain sanctions, but could not disburse basically. So those will be getting converting in the coming years, basically, coming months. Apart from that, I think there is not much to read on that ratio.
Okay, so it's largely because of the RBI circular that.
Yes. Certain good amount we got a sanction 25% growth, but disbursement didn't happen because certain formalities customer yet to be complete as per the revised what disbursement to be treated.
Got it. And is this the same thing that impacted the NIM? You mentioned that there was some RBI circular on the NIM impact. And, if there's a way you can quantify that potentially.
I think NIM is naturally we've seen certain compression in my yield has also impacted. Major component is also my assignment income is less in this quarter. And the cost of borrowing is a natural increase we have seen basically. So that entire something's compression at the NIM level or spread level got majorly I think majorly helped us to bring down at a OPEX saving basically in this way. So ROA impact is very minimum, is a 15 basis point, which will be, let's say, get positive in the coming quarters once we will have a better assignment income in the coming quarters.
Got it. Great, Ghanshyamji. Great, all the best on the quarters forward.
Thank you.
Thanks, Dana.
Thank you so much, Mr. Shah. Ladies and gentlemen, due to time constraint, that was the last question. I now hand over the conference to Mr. Sachinder Bhinder, MD and CEO of Aavas Financiers Limited, for closing comments. Please go ahead, sir.
Thanks. As we conclude today's earnings call, I want to express my heartfelt gratitude to each one of you for your participation and engagement. The dedication of our team, the trust of our shareholders, the loyalty of our customers have been instrumental in our growth. In our Aavas 3.0 journey, we are dedicated to constructing a robust framework that supports our ambitious growth and ensures corporate governance, asset quality, sustainability, and resilience. I express my deepest gratitude to all our regulators and stakeholders whose constant faith and support have been helpful in the journey. Together, we shall forge a new era in affordable housing and MSME finance, empowering countless lives and reshaping India's socio-economic landscape. Thank you and have a wonderful financial year ahead.
Thank you very much. On behalf of Aavas Financiers Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.